All right, it's our great pleasure to welcome back to the show our friend, the Blind Squirrel Macro, Rupert Mitchell. Rupert, thanks for coming, buddy.
Evening, Kev. How are you?
Yeah, I'm good, thanks. Well, actually, it's morning for you in Australia, and you're a real trooper for getting up early and doing this. What time is it for you?
Oh, it's not too bad. It's our clocks came forward last weekend, so it's 7:15.
Okay.
Yeah.
Now we have lots of things to talk about. We brought a deck, so we're going to kind of reference this along the way, and we're going to talk about the different charts that you've included. But I was laughing with you before we started because I said you're missing a stock, and you've recently had a great call, and your great call is short Tesla. And I was thinking to myself, well, why isn't he talking about this? And one of the things before we start, I just wanted to say, I wanted to kind of jab you a little because you said to me for the longest time, why are you wasting your energy shorting Tesla? Why are you doing that, Kev? And you actually went away from it for a year, didn't think about it. And then all of a sudden you show up at the exact right time and say, it's time to short this bad boy. And boom, you hit it right on the nail on the head. How did you do it?
Oh, well, I read the Barron's cover. No, I just, I mean, a number of things, right? I think I'm not going to re-rehearse all of the arguments. And actually, with hindsight, there was a smarter way of doing it than I ended up doing it, which was to be long Uber into the event.
All right.
And actually, that's quite frustrating with hindsight because essentially Tesla had sucked market cap away from Uber since the announcement of this so-called robo-taxi day, which was, just bound to be a disappointment. But the trouble is, and this is an interesting segue into my first slide, the trouble is I just can't bring myself to be long any of these stock-based compensation recyclers.
Okay.
And
so first of all, why don't you tell people what a stock-based recycler is?
Well, it's the same old canard about adjusted EBITDA, and all of these tech companies adjust their cash flow for stock-based compensation.
Okay.
So everyone's really excited about Uber's positive free cash flow since, in the course of the last 8 quarters. But if you strip out stock-based compensation and go back 5 years, right, in aggregate, Uber's lost $6 billion, right? There isn't any positive cash flow there at all. It's just an accounting sleight of hand. And actually, if you look across, so much of the belly of the Nasdaq, you've got a bunch of companies that just are glorified stock-based compensation recyclers. I think this has been something that I've sort of been banging on for a while, but I put this short on a Wisdom Tree cloud ETF. Now, this is quite an interesting product, which is essentially, there are some big beasts in the jungle like Salesforce and Adobe, which are always going to be in receipt of passive flows. But this is like an equal weight of the SaaS companies. And so effectively, it's overweight the belly of the enterprise software businesses. So, I mean, there isn't a constituent in there that's more than 2%, and it rebalances every 6 months. So you're never going to get a sort of runaway pain. And
all right,
so,
before we continue, what's the symbol for this?
WCLD, Wisdom Tree Cloud, right?
Oh, that's what the slide. Okay, I get it. Short WCLD is the ETF.
Yeah, and just to say, I will upload a copy of this deck so people can have a look at it afterwards. I'll just stick it on my site. And so I had a look at all of the cloud ETFs, and these thematic ETFs are a real bugger sometimes, Kev. I mean, you've got basically they all like to find a way of going overweight in their index, the hottest name, right? So the Fidelity Cloud ETF's got a ton of MicroStrategy in it. The Mister.
Come on. How is that the cloud stock?
It's a bit like that Artisan Emerging Markets Fund, right? That was overweight Nvidia earlier this year.
Yeah.
Biggest position in Nvidia for an EM fund. I mean, so
I've
you
heard
just
of actually some of my buddies telling me that they manage Asian money, and they actually get asked how much of your performance is the result of Nvidia. And they're like, well, none. We don't trade it. Like, that's not our stock. And they're like, because so many people are just finding excuses to be long Nvidia. And so, allocators are spending lots of time trying to figure out and back out how much of the outperformance of a lot of these funds is just the result of nailing this one stock.
Yeah, I mean, the importance of lifting the hood on these thematic portfolios is really, really high. And actually, and we can talk about this in a second, but so many people, you're an EM fund, and obviously EM managers have been finding every reason not to own China. The irony of them wanting to own Nvidia instead, we can talk about that in a second. but the issue, I mean, it does feel like this market, today apart, I'm just looking at today's performance. It does look as though we're trying to wobble again, but the market feels like it wants to go up. And we were talking the other day about, everyone, all the wise guys are saying shorting's stupid, and everyone's on one side of the boat. But against this short position in WCLD, I've got an out of the money call option on the Qs, on the triple Qs on the Nasdaq 100, just to protect myself from a big right drift into year end, which is possible.
Yeah. And listen, that's a way that more and more guys are handling this. And the fact that the right tail is so cheap is a great way of playing it.
It's so cheap. You can buy a 30 Delta call out to next March for pennies right now. So why wouldn't you do that? And what it does is it allows you to be short this basket of rubbish, right? And you've effectively got a sort of 4-for-1 payoff, right? If you look at a 20% move up or down in both the Nasdaq 100 and this basket of SaaS companies, if that basket goes down by 20%, your call option's worthless. That's 4x the payoff of the other direction, right?
Assuming the spread doesn't rip in your face. Right.
Yeah,
but that never happens. There's never a pair trade that goes against you that way.
But actually, so I mean, where have I been focused on the long side? I mean, in when it comes to US equities, it's really I really like the look of material stocks.
Okay, which brings me to our next slide here, which is long materials, short utilities, and I laugh because it's another pairs trade.
I know you. I actually I actually have them both on and written up independently.
They're not a pair trade. You just included the both of them in this slide. Okay, got it. So why don't you walk us through the long materials to start with, and then we'll move on to the short utilities.
So I mean, back in as the .com 2000 bubble was blowing up, right? I remember sitting in Hong Kong, and the tech team was literally 4 times the size of the rest of the investment banking department put together. And there were a couple of guys from the Midwest that called themselves the industrials team. And in those days, even they were pitching a B2B e-commerce play called iSteel Asia, i.e. steel repars, because they were so desperate to get in on the act. But then if you look at XLB versus the market from 2001, it outperformed the SPY, outperformed the S&P by 100% over the next 8 years. And I just think there's a really good chance that these businesses, XLB is a really interesting product. I mean, XLI, the industrials ETF, has managed to find bloody Uber in it. It goes back to my point about looking under the hood. But if you go to XLB, you got lots of chemicals companies, paint companies like Sherwin-Williams, cement companies. You've got a couple of miners, Freeport's in there for copper, and you've got Newmont for gold. It's a really interesting basket of names. And if you dig into if you dig into the consensus forecast for the underlying names, these guys are compounding EBITDA growth over the next 3 years of 11-12%, right?
Nobody cares.
And nobody cares.
Yeah.
And nobody cares.
That's the shocking part about it.
and so I'm long that one for, the long term. It does look like it's really trying to break out. I mean, this is a relative versus the Utes on the chart here. And we can talk about the utilities because I've got a bit of a bug in my bonnet, and our mutual friend Chase Taylor has been teasing me about this ever since I went short them in May. I look like an absolute genius for about a month, and then they have recaptured the AI afterburners, particularly off the back of the recommissioning of 3 Mile Island.
Right. Is Chase long? Like, is Chase
He's
long?
long.
He loves
He's
them?
long. He's long and crowing. My point on that, and I totally understand that for certain IPPs, right, the nuclear renaissance is really good news. But the trouble is, the rest of the US utilities own regulated assets that are old, aging, in dire need of ruggedization. And all utilities are not created equal. And this chart's got massively over its skis, and we've got a sort of investor base in there now, which is sort of schizophrenic. They need to decide whether this is a sort of rate sensitive defensive stock, or it's an AI growth stonk.
It's both,
right?
Rupert.
It's both.
It is. It's both, buddy. That's the beauty of it. That's what Chase would say. That's why you got to own it. Listen, I agree. It is the most. I think I've seen some stuff from the prime broker guys that says that's like we're 100th percentile in terms of the amount of exposure to XLU or utilities in the hedge fund community. Like, it's off the charts. They're chasing. It's another little one of these mini rolling bubbles. It's another one. It's just a tinier one. Like, it's the same thing. This market does this.
And some of the individual names like Constellation and Vistra are just complete skyrockets in there.
Yeah. The only thing that I've learned is that whenever you feel like when you have one of these things that you've thinks has gone too far, and when you're like, I got to load up here, you should take a big breath and go away for like another 2-3 months. Like, that's what I honestly feel like.
You mean load up on the short side or load up on the port?
Right. In terms of fading these things.
If you look back, I shorted into a sort of fading momentum play in May. It looked like it was giving up the ghost. I as a rule, I really don't try not to short stocks in strong uptrends, but it did look like it was fading then. And then, as is ever the case, I had early wins and got married to the position.
Oh,
right. Yeah. And now I can't bring myself to take it off. So much for disciplined trader. It's become a pride thing with Chase, I think.
Oh, that is funny. All right, let's go to this next one because I think this next chart, China, is great. You were early here. This makes up for all your XLU transgressions. You were early on China. You were buying it, and you were a vocal bull. But I thought before because a lot of people know the story about what's happening currently in China, I'd love to just get back to your a little bit of your history. And I think that if I recall correctly, you were part of the team at Barings, or was it HSBC? I can't remember. That was in charge of helping. It was Barings to help with the Hong Kong Central Bank buy stocks.
Yeah, that's right. So, I mean, back in, I ended up in Asia in my late 20s because of the Asian currency crisis in '98. And as part of an intervention by the HKMA, Hong Kong Central Bank, to defend the Hong Kong dollar peg, like complete ballers, they went in, banned short selling, and bought 10% of the market. And then... True?
Is that what they did? Yeah, so they're getting outflows in their currency. So they say, not only are we going to, halt all that, we're going to take, buy everything that's coming at us that way, but we're also going to, ban short selling and take 10% of those stock market down. Did they just print it on the balance sheet? Like, did they not worry about paying for it?
Well, they
like issue bonds for it, basically.
No, well, the Hong Kong dollar peg is fully backed, right? So they just had the money, right?
So they just sat there and said, "Okay, bought from you."
They just lent on the bid. swept the offer, and just, I mean, it was amazing. So, I mean, the intervention was architected by a guy named Norman Chan and his right hand Amy Yip, and they're still very much around. And they then needed to figure out what to do with this 10% of the market that they owned, and so they hired Barings. Well, we were owned by the Dutch Post Office by then. Barings, Flemings, well, Jardine Fleming, which is now part of JP Morgan. Then obviously the Vampire Squid got the nod as well. And so the three of us ended up creating, this is 99, right? So exchange traded funds are a pretty new product. I mean, the Spider was around, and obviously I know you invented the Canadian Spider, Kev.
Well, not only did we invent it, and I didn't invent it, it was before my time, but it was ahead of the XIE. It was ahead of the Spider as well. And you know what I just recently learned? I'm going to do a little tooting for Canada. We were also the first to list a bond ETF.
Now, I don't think they make any sense, but we can talk about that.
Bond ETFs? Oh, I disagree. But anyways, that's fine. That's what makes a market. Okay, so you guys created an ETF.
I love the fact that they exist, but I have a thing about ETFs on illiquid underlyings, right? And yes, a liquid
details.
Details, precisely. Anyway, the way in which the Hong Kong government got its money back, or the Hong Kong central bank got its money back, was via doing a jumbo $4 billion offering of basically Hang Seng market cap weighted ETF. It was called the Tracker Fund of Hong Kong. Anyway, so I mean,
that's what they did. They basically threw it all in an ETF and just like said, "Here it comes at this price."
Absolutely. I mean, well, it was more than that. So it was clever. I mean, so basically they offered the index at a discount, and for retail investors, they got warrants on top of that. And so it, Asian retail investors see value when it hits them like that. And it was an absolute blowout. But at the time, institutions around the world were deeply skeptical that the thing was possible, and frankly most of the deal team didn't think it was going to work, and then Hong Kong retail just rolled in and swept the book.
Really? Did that warrant that was associated with that thing trade as a listed product?
No, it didn't.
You had to just exercise it. It was
you basically had to keep your warrant dematerialized, in order to
well, that's kind of boring. It would have been more fun if they listed it.
It was not registered paper, but
it wasn't transferable.
You had a Hong Kong ID card to do it. It was, but it worked incredibly well. And what was really clever is that they had an ability to sell even more stock to the market makers over time. So they linked the ETF creation process to the futures exercise and alignment settlement price. So in rising up days, you could get a sort of a VWAP discount as a dealer. You could buy the underlying shares at a small intraday discount, and they sold another $4 or $5 billion worth of stock through that tap mechanism over the course of the next few years. I mean, they completely nailed it.
Wow. Okay, let's take that story of a central bank nailing it and let's put it on to today. A lot of people are skeptical about the government and the People's Bank of China and the actual Chinese government with their stimulus measures. Are you, and how do you see this playing out?
I think it was inevitable that people would be disappointed about the scale and extent of the stimulus. And frankly, if you were buying FXI calls, 3 weeks ago, these measures weren't designed for you to make money on that trade, right?
Yeah.
And actually, if you see what's happening, it looks like what really matters is happening is that local investors are opening brokerage accounts and starting to equitize some of their savings. And ultimately, that's going to be a more slow and deliberate process over time. But, the government has effectively said to domestic investors, it's okay to own equities now. We've got you, right?
Okay, so
And
then
I think that's a game changer, right?
right,
And you know, listen, I have the luxury of having a much lower basis than the recent move, right?
right.
And it's going to be painful for sort of latecomers to the trade, but there's, you know, a lot of people were sort of selling FXI puts and selling the A share puts, right? Because on the bull side, I'm actually surprised you weren't doing that, Kev. You like to
I
sell a bit of.
was, I was, I was, of course, vol goes through the
I
roof, and
actually
I'm
didn't know
bullish
that,
China.
but I
I'm
do
like,
know
oh yeah,
that.
that's all right.
So and also the other way I'm doing it is I have deliberately taken some volatility out of my Asian exposure with the names that I'm looking at. So instead of buying Tencent directly, I own Tencent via the Amsterdam listed holding company Prosus, which has a jumbo stake in Tencent, but also has a bunch of other holdings in private and public tech businesses,
Oh
which you
yeah,
get for free.
I forgot about
Yeah.
this, Arb, and I think you mentioned this before. So what's the symbol there again?
PRX on Amsterdam,
Right,
Prosus.
and so and how much of it
So what
is
it used to be, so the stake that, so I mean, everyone talks about Massason's stake in Alibaba, which she picked up for pennies, right? Well, there was another deal done by the South Africans, a publishing company called Naspers, who were very early into Tencent.
okay,
And, at some point, Naspers, before they did this restructuring to create the Dutch holding company, Naspers was some crazy percentage of the Johannesburg Stock Exchange, right? And the Naspers 10-cent stub was one of the big sort of risk arb trades for
right.
years. Um,
And so
and anyway,
is it blown out now in terms of that stub? Like it must be cheap.
it's still dirt cheap,
Yeah.
right? It's still dirt cheap.
Is it ever going to
Um,
get? Is it ever going to get collapsed, or is it just kind of?
so they would have to do an awful lot of buybacks, right? It's always going to trade wide to
Yeah.
NAV, but what it does do is it takes out a bit of volatility, right?
Yeah.
And it also gives you that sort of confidence around margin of error, right? You don't worry when it swings around. You don't worry it swings around because you know that you've got this sort of big intrinsic discount there. Now
Okay.
that may be just psychological, but I like
Yeah.
it for that. The other thing is instead of chasing the K-web, right, which is the really popular China internet
Yep.
set, I really like EMQQ, which is the emerging markets triple Q.
Ah.
So
Yeah.
it's got a massive sort of 40+% weighting to the China tech names, but it's also got C Limited down in Singapore and Mercado Libre in Latin America. You've spread your exposure a bit more. And
Yeah.
actually EMQQ is the chart on that page
Right.
there, and that's all been China related.
And not only
funds.
that, it is beating the QQQs for the year now.
Oh, absolutely.
Isn't that
Absolutely.
amazing that like everyone keeps talking about Mag 7, keeps talking about Nvidia, and the reality is that the leadership is long gone from these stocks.
Yeah, but really that's a reality only of the last few weeks, right?
Yeah,
I
but
mean, we had a really good start to the year, then gave a lot of it back, right?
for sure. But I'm just saying that everyone's still focused on Mag 7 and it's not the one leading. Like
Yeah.
it's not the stocks that you should own.
Although actually, I worry, and I think you and I would probably disagree. My sort of right tail concern is that, and it's death for people like us that like to write about markets. But if we could see another dose of Mag 7 leadership again. I mean,
You
I don't think the stakes yet in that vampire.
Why do you still worry about that?
I think that the narrative cycle around AI is not going to be allowed to die. I think at certain points, people will persuade themselves that the Mag 7. I mean, I'm talking about the main hyperscalers here, not the full definition of Mag 7. People will persuade themselves that they're starting to look relatively cheap versus the broader market. Listen, I think it's a bogus argument, but I do think it's a risk, and I'm not going to be sucked in, but I do feel the need to hedge it.
Okay, fair enough. I understand completely. I think the numbers have finally started to roll over in terms of like the rate of growth, and it'll be tough. They're going to go find something that's better. And I actually even think they're going to go look at China. And given the fact that there's this huge underweight out there in terms of people's exposure to it, if that gets any
Oh
sort
yeah,
of
and
legs,
we haven't even begun to move the needle on that.
yeah,
Right? Because you've got allocators that have been telling their clients that China's a no-go for 4 years. They cannot turn on a dime.
yeah,
Right?
they're
'Cause
they're
makes
just
makes it look
scheduling the
ridiculous.
meetings to talk about it.
Yeah,
Yeah,
and still wondering what they're going to tell them.
yeah.
Right? Yeah.
And,
So,
and
and the
and if
other,
it goes up, and like it's going to be painful. The reality is that they just missed like 30% or whatever it is. If you're an EM manager, you just missed 30%, and it hurts.
and guess where you're really overweight?
Oh,
India.
here we go. Next slide. And this has been something that you've been focusing on for a long time.
Listen, I mean, so first up,
India.
I was way too early on this. I went a year ago. I thought that India was looking overdone, and I've been proven to be 100% wrong on that. But at the time, I was concerned about. I was concerned primarily about valuation, the
Silly guy.
currency. What's that?
Silly guy worrying about valuation.
But actually, the chart here is the rupee against the dollar, right?
Yeah.
And going back a long way. And this currency has been a serial devaluer, and it's managed to hold steady pretty well since the Ukraine invasion, right? Because the dirty little secret is that the energy trade of essentially laundering Russian energy through India has been a complete dividend for that economy.
Do you think it's that big? It's big enough to move the needle on the currency?
Yeah, I mean, India's a net energy importer. You've also, but I think where I went
exporters
wrong,
now.
What's that?
I thought they were exporters now because they're
of product, yeah.
Yeah, because they're bringing
Right.
in all the Russian oil on the sly, and then all of a sudden they have all this oil to sell.
Yeah, and the other thing is, I mean, ultimately, everyone owns India because it's quote unquote the next China, right? And I don't understand how that sits with their "well, I don't want to own China" thesis, right? But anyway, what I would say on this slide, and we can talk about the equities a bit more in a second, is I mean, Indian FX is quite tough for retail to trade, but if you look at USD INR vol, it's as cheap as it ever has been, right?
Oh, really? Oh, I
So as
didn't
an
know
FX,
that.
if you have an account that allows you to trade rupee options,
Yeah.
USD INR calls, 25 delta calls look as cheap as they have forever.
Oh, that's fascinating. I had no idea. That is an interesting tidbit. All right, let's talk about stocks, since most people like to talk about stocks. The Indian stocks.
Now, part of the reason, so that's the next slide. Yeah. So part of the reason, I mean, I'm going to talk about valuation. If you look at the amount of inflows that INDA, which is the iShares India ETF, has received, I mean, it's just been a sort of sucking sound of liquidity.
Right.
And it was very interesting to see the inverse correlation of Indian equities and China equities on the recent spike. Everyone is massively overweight in India versus they're underweight in China, and that could create real headaches for Asia Pac and EM benchmark money over time. It does, as I mentioned, look like the currency wants to break down again. I really do think that I would regard myself as an AI agnostic at the moment. Okay. But if you think about India's export economy, 30% of India's export economy is IT services. Now, if these chatbots are half real, right, we've got a real headwind
Right.
economically there.
Hear you.
And I also think that the demographics argument is a little bit tricky, in that, yeah, it's all very well having a young population, but they've got to have decent employment, right?
Right.
And
Yeah.
so it can end up being a curse rather than a dividend if you're not careful. So I mean, I think ultimately, I think this massive overweight India, underweight China thing is going to get reversed.
I was just thinking while you were saying all this, if you were like worried about global economy and you were looking for stock markets to short, this might be something that's like a nice dark side bet.
Yeah, yeah, and I think the currency is probably a better one, probably a better bet. But
Right.
I think that you've got a liquid ETF in INDA, and if you feel like you need to have some kind of dark side hedge on,
Yeah.
I mean, I listen. I'm to be clear, I don't have a position yet,
Okay.
right? And I mean, it does look like they're starting to wobble, but I think that's still China-related noise. And let's see how those allocator meetings go over the next few weeks and months, because I think that.
Yeah, I think you're spot on. I think the reality is that everyone was hiding in China, in India, and now that China, even
And
if
the
they
other
just
thing
kind of they
is
just drift towards bench, not even run to bench, just drift towards bench. That means an unwind of this trade. The buying disappears.
absolutely. Now,
Yeah.
one thing that I have got wrong is part of the explosion in Indian equities in the last couple of years has been the awakening of Indian retail.
Right.
Now, that has made some of the nonsense we saw with Robinhood in 2020 and 2021 look anemic, right? This is, but all I would say is that this is an investment cohort that is brand new, that has never had even so much as a bump in the nose, right?
Okay.
And there isn't a deeply ingrained equity investing culture, right? It's cash and gold, right? Historically.
Right.
And so I think all of that enthusiasm could wane quite quickly if you're not careful.
All right.
Right.
Next slide is the squirrel really does not like the long bond. And I love this. And I know that there's a lot of people that are talking about shorting the long bond, but I just kind of want to push back to those who are saying, "Oh, that's a crowded trade," because I was going through all what what the Bloomberg experts were saying, not our experts or Bloomberg PMs, and it was like, Rupert, it was across the board. Everyone is trying to buy this back up in yields, and they think that this is it, 4.25, time to load up the boat in tens, or go out to 30s. You feel differently. Why?
I just don't see the risk reward, right? Why, if you want to own, I mean, if you can earn near as damn it 5% in the front end, right? Are you really thinking that you're going to have this kind of massive capital gain by owning the 30-year or owning the TLT?
I think they're thinking that the rates are going back to 1 or 0 at the front end, and 30s will be 2.5.
I mean, the world in which they do that, right? Yeah. How's your Nvidia looking then, right? I mean, I don't see it. I don't see it. And listen, I have a bit of an allergy to certainty at the moment. And
that's a great line. Allergy to certainty. Explain to people what you mean.
Everyone's been made a fool of by recession calls, recession not calls recently, and I think and it's very easy to batter central bankers. I don't imagine they're finding life to be desperately easy either at the moment. It's confusing, right? The economy is at one level really working for the high-end consumers. What is Peter Atwater's classic K-shaped economy, right? And then there are other corners of the market, like commercial real estate, where no two ways about it, it's really hurting. And so all of the economic data in the aggregate looks fine. Yet we know that there's pain in pockets under the hood. But the trouble is, monetary and fiscal need to be driven by what's going on at the aggregate level. So to be certain about timing a recession, to be certain about how you should be positioned in the long bond, it just doesn't hang together with the facts, right?
Yeah.
And ultimately, if you're going to go and take duration risk like that, I mean, first of all, you know, the bond market's not stupid, right? I mean, the forward, you, as you have pointed out on many occasions, your bet when you buy bonds is to beat the forward price, not to beat spot, right? And not to correctly call the direction of yields. You've got to beat that forward price by a margin to make money, right? And so to make that call requires an even higher degree of certainty about the path of bond prices. So why do it, right? Ultimately, you know, you can sit in cash, and ultimately when the shit does hit the fan, that's all you really want is US dollar cash, because you don't make your money on the shorts. You make money by having liquidity when the prices are down, right?
Yeah. Well,
and let's see just how liquid TLT is.
Yeah. I think the real question, though, Rupert, is are you more worried about a deflationary problem with this economy, or are you more worried about an inflationary?
I'm the other way. And actually, I mean, if you go to the next slide.
Okay, let's do that.
If I've been talking lots about replacing bonds as we go into a world of inflation volatility, right? I'm not saying that I'm not calling for hyperinflation, but I think that we are entering a period of inflation volatility where the low end of the range is going to be 2.5 plus 3, and we might see spikes to sort of mid to high single digits, but it's going to move around. And the inverse correlation of stocks and bonds that the market has enjoyed for most of our time in the market since the early 90s, right? It's just not, you can't expect that to be there. So what else can you put in to a retirement portfolio in place of, you know, your long treasury holding? And I've been sort of nibbling away at this theme for about a year now. And the two things I was going to talk about today was having a look at long dated crude contracts. So I'm talking 3 to 5 years out. And, you know, ultimately crude oil is a nominal asset, right? And the only people that trade long dated futures contracts, I mean, it's what I call it is it's a compliance market. So people only sell crude out 5 years if they've been told to by their bankers. So they're an E&P company, right? And if they want their loan, they've got to hedge some of their forward production.
Okay.
Right. So ultimately, it's not really a real market. And I do see an upward drift of crude prices. I'm not really involved at all in the front end of the curve at the moment. But I think that, you know, $60-something oil, which you can buy out the curve, is an interesting place to own the asset. And the other thing that you get with it is a significantly reduced drawdown profile. So when people see the decks, and as I said, I'll upload them to my website so that people can download them for free. If you look at the drawdown profile of long dated crude versus the front end of the curve, you can really sleep at night. And I think this is going to be a nice inflation hedge, serving the role that serving the role that sort of treasuries used to. I
like it. I've never thought about that. So if we get a situation where nothing changes, these just decay upward.
Yeah,
it's almost the opposite of the bonds. Because the curves are inverted.
They just pull to par, if you like. They pull up to spot crude price.
Why do you think this exists? Like you mentioned the fact that you say that there's the selling from the E&P companies, But traditionally, there's always been that selling, and it's always existed, and we haven't had the same discounted, far dated stuff as we recently have had, unless I'm mistaken. Am I wrong?
Do you know what? I need to look at the relationship over a longer
Yeah,
time period. I mean, the trouble is with the front end of the crude market since 2021, 22,
yeah,
well, since COVID, is that, you know, the size of that paper market at the front end, right? And the recession, no recession, everybody's favorite macro hedge, the
yeah,
geopolitics in and out, it's just created so much noise, right?
yeah.
The ability to get chopped up in the front end of crude is
So I think there was a time that the far
fun.
stuff traded at a premium because I think people were worried. They rightfully said, okay, with some inflation, you expect oil to go up over time. You put in some risk of, something happening. And they were more worried about the kind of not having it. And like companies like, for example, you would be a jetliner. A jetliner, I mean, an airline company should be buying that. They should
No,
be
I
buying.
so actually I did look at that. So the
Yeah.
airlines, well, first of all, they're terrible. They're terrible. They're almost as bad as the fertilizer companies hedging with nat gas, right? And
I didn't
typically
realize are the FERT companies terrible on that gas?
absolutely terrible. If you look at the average cost of natural gas for a fertilizer company like a CF or something, they pay, a dollar over the average price
Yeah.
in
But isn't
gas.
that a function of the curve is steep and that they kind of anytime you're locking it in, you're basically, you're paying up for it on the net gas?
I, I'm not enough. All I've
Yeah.
done
Anyway,
is
so
I've looked at the quarterly numbers and compared their cost of goods sold to what the spot price of Natty's done, and they miss it by a mile every time. But the airlines are the same, and also they typically don't hedge further than sort of 12 to 18 months out,
oh,
right?
that's the real problem. They're not even sure they're going to be in business a year's time.
Yeah, precisely. Absolutely. So they're not operating in 36 or 60-month crude either, right?
Okay. So you
They're
have another.
really,
Oh,
they're
sorry, go
really,
ahead.
really,
Finish up.
and so there's the long dated crude, and the other thing, and is a complete treachery to the narrative arc, which is I have an allocation to the trend followers. So
Okay.
that's the next page, and back in the early second quarter, I sort of made a strategic allocation instead of bonds to a basket of trend following ETFs,
All
right?
right.
And I know that you're a DBMF nerd like me, and I historically had looked at, now to explain DBMF. You've had Andrew Beer on the show, and
Right.
DBMF is a replication strategy that seeks to track the SocGen trend index via a quantitative replication strategy. And
Right.
it's really clever. And I hope you get him back on the show because I've got a bunch of questions.
For sure. I should
that
let you do
I
the
want
interview.
And what I always used to look at these ETFs because I kind of wanted to know where they were positioned in the various contracts. Are they long bonds? Are they short bonds? What are they doing in the currencies? What are they doing in the various commodities? And what I was using it was as an input to my discretionary process,
Right.
right? Because I actually have a really strong sense that the sell side often gets it wrong in terms of how the CTAs are positioned and what might happen under various price scenarios. I think they're really selling tickets to the ghost train most
Oh,
of the
I
time.
think they don't you like I look at their things, I go, what are you talking about? Like the thing that
Yeah,
Andrew's using is actually using like he might be late in terms of
yeah. It's what's happened. What underlying moved the index, right?
right. So it's
And
like those are the actual positions these trend followers held, as
yeah,
opposed to if we use our model and try to come up with the theoretical stuff. But who knows what models everyone's using? You don't know.
yeah,
The only thing you do know is how those funds performed.
yeah.
So, anyways,
Absolutely.
Andrew's right, and I completely agree. I look at most CTA stuff when I get it, and you get it from like big name shops. And I just like, this is useless. I
Well,
don't care.
what's great about you've now got about 7 or 8 pure trend ETFs with daily disclosure of what they're doing. And it's
Okay.
possible to go and go, well, actually, that's not what the banks are saying that they're doing at all.
Oh,
Right.
really? Well, I
And,
didn't realize that. I should expand my, I only focus on the DBMF. I should go look at some
and
other.
actually, I keep on meaning to ask you, what it would be really interesting to do is, because you've been doing that for about a year, 18 months now,
Yeah.
would be to plot the positions versus the contracts. And you're
Oh,
much
yeah.
better at coding than me, right? To see, I think it'd be fascinating to see what the moving averages are doing over
Oh,
time
yeah.
when they flip, right?
Yeah. No, you're right. That is true. Yeah,
And
that
I
would
know
be
that
cool.
you've got the coding skills to do that. It's sort of
Barely.
slightly beyond my ken.
All right. So you take some of your portfolio. You've decided that you
Yeah,
don't want to own bonds because you hate them. You're doing long dated crude. You're replacing it with these trend. Is that like, so that is
yeah.
your,
So I own 6 of these ETFs,
yeah.
right? I've got a diversified exposure to the diversifier, right? And I went through. So you know who I mean by Niels Kastrup Larsen, the
No,
top traders unplugged guy. So
okay.
he works at Dunn Capital, and if you
Yeah.
ask
Dunn's
him
a big name.
nicely, yeah. I mean, I mean, Dunn is the OG of trend following, right?
Right.
They've got a track record that goes, an audited track record that goes back to the early 80s,
Right.
right? And what you can do, and this is what this traffic light chart on the page here is what you can do is you can look at model portfolios of US stocks, global bonds, gold, and trend. But for the trend, you're using the actual done track record, right?
Okay.
And what I did was to look at the returns and the drawdowns and the Sharpe ratios of various weightings to trend to come to my conclusion, which was, you want to be sort of somewhere between 10 and 15%. Now, I realize that is complete heresy for those of us in the discretionary business. But I actually really like realizing that quite a lot of the time, my trend position is completely fading what I'm doing on the discretionary side.
Okay. Let me get this straight again. So Dunn on their website. Is that correct?
Yeah.
So
So,
they
I mean,
have
I
a
think
place you could.
you might need to be an accredited investor,
Okay.
or but if you do fill in their online form, they'll give you access to their portfolio builder.
Okay. Dunn, I
Right.
believe, has 2 ends, right?
Yeah.
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 Okay. So you can go do that. And then what you can do from there is you can put in the different exposure to their
Yeah.
actual trend that you want. And you can see the difference in terms of the sharps, the max drawdown for various
Absolutely.
different periods. And then you can say, this is the position I'm comfortable with. All right. That's
Absolutely.
fascinating. Now the next page is like the actual performance of these various ETFs.
Yeah. So those are the performance. So actually, I mean, I started an allocation to trend in a terrible year. I mean, they absolutely killed it, being short bonds from through the hiking cycle.
Yeah. They
Right.
were really good at staying
They
short too.
they got badly beaten up by Silicon Valley Bank by
Yep.
that intervention last year. But and they've been suffering from a lack of real trend over the course of the last 12 months. But if you speak to any of them, they'll tell you that you can't trend follow the trend followers, right?
Well, I've
You
heard
can't.
I've read or heard something about that when everyone redeems them, they love going and actually just taking the other side of the trade and doing it PA.
Absolutely.
Yeah.
I mean, I think Jerry Parker says you should always buy my drawdowns.
Yeah,
Right.
exactly.
And I actually wrote about this in my note. It's free. I went through all of the various things you could try and be a smart ass and second guess a way to take this exposure. There isn't an easy way to do it. If the CIO of Dunn Capital doesn't think he can time his own strategy, how the hell are you going to be able to?
All right, that's great. And let's go with your final idea here, which is two ideas we got still. Hedging the
Well,
dispersion bust.
Well, you've written a lot about this in the last year. So, I mean, this is how to play the dispersion trade, right? I mean, the very crowded, all of the pod shops that are long individual name equity volatility versus short index volatility.
Right.
And I am back in my SPY straddle strategy.
Okay. Why don't you explain people what that is?
So what I'm doing is I am rolling a roughly 1 month out at the money straddle, so put and call pair on the SPY ETF, right? And the strategy revolves around basically keeping close to maximizing my exposure to implied volatility over time. Okay. Because if there is a rise in implied correlation, which is still sitting at incredibly depressed level, and that's the blue line on the chart with the red line below being the VIX. When this dispersion trade needs to be unwound, these funds need to effectively reach for the VIX, right? Yeah. It goes offered only. Now, you and I talked earlier in the year about you've been trading the October VIX contract.
Yeah.
Because and I had a look at that. So you would have probably bought it 1920, right? And you had 24 hours in which to collect your payday. All right. So that October VIX,
I did. I was gone.
You had to wear a 15% drawdown in that
probably
contract.
Worse than that, actually. I think, wasn't it?
15,
I think
18%. And then you needed to probably start selling on the Friday, and you needed to be all out by the open of the cash market on the Monday of August 5th.
But isn't that always how it is with VIX?
Yeah, it is. But
although to be fair, this one was especially quick. This one was especially quick.
With my straddle, right? I didn't endure any of that negative carry in the run up to the vol event. Actually, it carried positively
because you were getting upside vol.
It carried positively up until the event, and yes, I was out that day or that Monday as well. Yeah. But I got back in. What was amazing was how quickly the VIX collapsed back down.
Shocking!
And correlation came back down. I mean, they just stomped on it.
I couldn't believe it.
Yeah,
it's just kind of crazy. It showed you that the worries about the actual underlying economy aren't there. That's how I interpreted from it. Like they were just like, nope, this isn't actually an issue yet. And it was a technical covering of positions. And I actually do think that the kind of dispersion and all those trades exacerbated the move and made that VIX bid faster and quicker. But the fact that it came back so quick was because the underlying fundamentals weren't that bad.
Yeah.
And until we get like a real deterioration in the fundamentals, it's going to be tough for that trade to really work. All right. So what's the final thing here? You got a short credit trade without negative carry.
Yeah. So I've been looking for a retail friendly credit hedge for years.
Okay.
Right? And there's an ETF which is the inflation, which is the interest rate hedged HYGH.
Yeah.
Right.
Okay. Why don't you explain to people what that is so they can just understand that?
So it's a pure exposure to credit spreads, right? So it takes the bond mathematics out of the equation. You are literally just exposed to the direction or the path of credit spreads. Right. So I mean, if you've got a corporate piece of paper and it yields 6% and the risk-free rate is 5%, your credit spread is 1%, right? And I want a position that doesn't carry too negatively, which gives me a payoff in the event that credit spreads blow out, right? Now, the trouble with something, I mean, there's plenty of ways for institutions to do this very easily. They can buy credit default swaps, right, on the index, and it's super liquid, and that's really
the IG, the CDX one that trades and it rolls every 6 months and stuff like that, and it's a basket of.
Yeah, but you effectively need an ISDA to trade it. You need to be a big boy,
right?
The HYGH would seem like an elegant way to do it, but you'd want to be shorting it, right?
Yeah.
And that means you're paying, I mean, the last time I checked was like a 5% borrow cost, right? And then you're funding an 8% dividend yield, right? So this thing carries terribly. Then you could do, and this is quite a popular strategy, people buy puts on HYG, right?
Okay.
And that carries much less expensively, right? But you've got to get the timing right.
Well, and you could be wrong. You could be right on credit and wrong on duration.
So I found this ETF. It's called SJB, Short Junk Bond, right?
Okay.
Right. And essentially, it does this. It does this for you. Now, effectively it's like one of these daily reset ETFs, right?
Okay.
Which everyone's told you, your mum's told you to stay away from those nasty kids with their overstructured ETFs. But actually, this one's okay. Right.
You hear that? Rupert's mom says this one's okay.
Well, no, because what kills you on those daily reset ETFs, right? And why they've got a bad name is if the underlying is volatile, right? You get absolutely whipsawed by selling low and buying high, right? The thing about credit spreads is they don't move around that much until they really move. Right. So a daily reset,
a lot more, which is what you actually want on this.
Absolutely. So in the meantime, this product is like you're just sitting in T-bills, right? So this product actually carries positively, right? You're not getting the same as if you were, in your Treasury Direct account. But you've got this exposure. Now, I would argue that with high yield credit spreads where they are at the lows on a multi-year view, that's why the title of the piece about this was "I'm axed at zero." I mean, ultimately, there's not much further that these spreads can fall.
Well, they said that about swap spreads too, Rupert, and they went negative.
But it doesn't hurt you if it does that. I mean, ultimately, there is, yes, credit spreads could theoretically tighten even more than they are doing now, but I'm prepared to own that.
I got it. So SJB, it is short junk bond ETF. It's got endorsed by Rupert's mom.
Yeah, mom's all in.
Rupert, it's been a real pleasure to have you. I'm going to spring this on you. I don't know if you're ready for it. We didn't talk about this. Do you have a triple B for me? A book, a broadcast, which could be a podcast, a TV show, a movie, or a band that you've recently stumbled across that you're digging?
Do you know what? And I'm going to be really slow on the uptake on this. But I have just started watching season 1 of Industry.
Oh, people love it, and it's come back in season 3. It's the closest thing to actual real trading.
Well, I don't know. I am kind of annoying. It's you have to turn it off when the kids are around, because I tell you what, there wasn't nearly that much sex during my graduate training program. Mainly,
well, there wasn't any in mine. So.
Yeah, no, I'm enjoying that, but apparently it gets better. I mean, season 1's quite corny.
Yeah.
But I'm investing in it because I've been told it gets really good by season 3.
I love the guy that's the risk manager that walks around with the baseball bat.
Oh, he's a desk head. He's not a risk manager.
Is he? Is he just a desk head?
He's the head of cross asset sales.
Oh, I didn't realize that. I just love him walking around with the baseball bat, ready to swing it at anybody that's getting out of line.
We've all seen one of those on a trading floor, haven't we?
All right. So for those who are interested, it's Industry. I think it's HBO, is it not?
It's HBO. It's HBO. Yeah.
And I think there's a new season, so go check it out. Rupert, why don't you tell people where they can find more about you in your letter? Explain to people how it all works.
So blindsquirrelmacro.com, at Squirrel Macro on Twitter. I write, yeah, 1.5 times a week
Yeah.
on everything from shorting junk bonds to Indian FX to a bit of equities from time to time.
Right.
And try to keep it light, try to keep it fun, but please check it out.
And for those who are interested, you actually do one of the greatest jobs at navigating that whole problem with free and paid portions. So many people like they send you like like ends up being like four sentences, and then says
No,
if you want to read the rest, click here. And
no,
I find your free is actually, although it's not the full letter, there's a lot to chew on there, and people are going to be impressed. So even if you're not interested right away at signing up to pay for it, go check out his free, because there's still a lot of value added there, and it is
yes,
not
I'm
spam.
I'm I'm always going to write a standalone free product. I'd always do that. I mean, it might be terribly bad for business, and I do hope over a while, there is another 60% of stuff, and I've got a members Discord server, which is fun, which is kind of like my live scrapbook and comments, which is getting more active. And yep, come and check it out.
All right. So it is Blind Squirrel Macro. Rupert Mitchell,
.com.
thank you. Oh, yeah, .com. Thank you very much for joining us. It's always a pleasure.
Thanks, Kev. Loved it.